Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management e-News. Thank you for joining us. We hope you all had a wonderful Thanksgiving. As we head into the end of the year here, we thought we'd talk about the markets a little bit and what we think we should be looking for the rest of this year and then into next. So we sit here on the last day of November, and the month of November has been gangbusters. As we sit here today, the S&P and NASDAQ are up over 11% for the month of November. The small cap index is up over 20% for the month of November. So we've had a gangbuster month, to say the least. And it's more evidence, as we had been talking about all along, that the market was much more concerned about what the Federal Reserve is doing and the potential for more stimulus than the results of the election. Quite frankly, the election results, whether you like who won the presidency or not, markets really like the outcome because we got a split government, and historically that's been when stocks ultimately do their best. So again, markets look through the election like we thought they were going to, and they are continuing to look at the Federal Reserve with the pedal to the metal, and also some second round of stimulus that is most likely going to happen in the trillions, and that's going to be good for risk assets like stocks. The one thing we would urge you all to do, and I know we're doing it in our office, is to make sure you're still paying attention to risk. We hear anecdotally from lots of people, and Josh can talk more about this, that people are taking more and more risk, whether it be in the real estate market or in the stock market. But it reminds me of a Warren Buffett quote. And Buffett said, "The less prudence with which others conduct their affairs, the greater prudence with which we should conduct our own affairs." And so it reminds us risk management. It feels like at times like this, when markets are levitating, it feels like you don't need to worry about risk. But remember, the more stocks go up, the more risky they are. As stocks sell off, it's the opposite. When stocks are selling off, that means risk is coming out of the market. When stocks are going up like they have been, it means risk is going into the market. And I know a lot of you feel the opposite, but now is not the time to be ratcheting up risk in any part of your life, even though a lot of people out there are doing that. And if we go back and we look at some of the names that are trading at 60 times, 70 times revenue, which is crazy, it's even more ridiculous than we saw in the late 90s, and we know how that ended. So Josh, you can talk about some of the anecdotal stuff you've been seeing.
Yeah, well, it's one of those scenarios where I don't think we've seen such an extreme reversal in sentiment over such a compressed time frame really ever, even certainly in your career. We're now sort of in that extreme greed area of the pendulum, and I have talked about on the radio in the last couple of weeks a particular electric vehicle maker over in Eugene that has about 1.5 million in revenues, that's now trading north of a $700 million market cap. And I'm coming off of a morning where I just had a couple discussions about electric vehicle stocks with various clients. And this is just another example that points to indexing, because over time, you're going to overpay for electric vehicle makers, and let's face it, the auto industry is not a good business. It's highly capital intensive for a very low margin end result. You're going to overpay. The growth will never materialize, and then over time, you didn't participate in that huge volatile swing to the upside, but the index always wins. And so, that inevitability, we're here to remind you in times when the sentiment is so aggressive, and almost every call we have is with investors that want to take more risk. In your portfolios, we own a high allocation to small caps because they're highly levered to economic activity, and as reopening plays out, that is your risk gauge, and that's where you're taking additional equity risk in your portfolio. And you've really seen sort of as that sentiment has shifted, as Tyler sort of highlighted how well small caps have done, that's our risk proxy. That's our biggest return enhancer in the portfolio. Many of these thematic bets aren't going to play out. The sentiment is very positive now. It will reverse once gravity and reality sets in.
Yeah, this also reminds me that don't mistake a bull market for genius on your part. I know a lot of you that are clients aren't doing any of these crazy things, but there's a lot of undue risk taking, and we know how this story ends up with a lot of people losing all of their money. So we're reminded that now is the time to stay globally diversified, own lots of different asset classes, including small cap, mid cap, international, and over time, that is the best risk-adjusted return. And for you, those of you that are retired, that's certainly something that's important to you. that is our e-news for this week. If you have questions about your specific situation, you can always call the office. The number here is 800-743-0988, and we can answer any of your specific questions. And we'll see you back here in 2 weeks.